The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box Europe. It's Friday. You've got there. It's a bit, well, not even finished on the session yet. It could be another oscillating session. Anyway, Juliana Tattlebaum and myself, Steve Sedgwick, will try and talk you through some of the craziness of these markets, because AI valuations once again rattling investor sentiment. Is that the real trigger, though? Maybe, maybe not. But anyway, triggered a sell-off in the Nasdaq and several major tech names, while hopes of an upcoming Fed cut get a reality check, with December's meeting now seen as a coin toss. Talking of tossing coins, is that what the Treasury's doing in the UK? I don't know, but budget backtrack. UK Chancellor of the Exchequer, Rachel Reeves, reportedly prepares to U-turn on her U-turn on income tax hikes in the upcoming budgets amid fears of voter and party backlash.
Wind in its sails, Siemens Energy full-year adjusted profit surges almost 600%, and the firm hikes its outlook as AI data centers power energy demand. CEO Christian Bruch tells CNBC he expects the momentum to continue.
We see a good electricity market. We have very successful products positioned, and the organization has been tremendously good in working off also a big backlog.
You know you're going to have to hold me back, don't you?
When don't I have to hold you back?
Not one of those choke collars. I am genuinely, like, you know, with the one with the dogs, where I don't use that. I don't use that on my dog. He gets away with murder. But there's so much to discuss. It is so exciting, these markets as well.
I actually don't blame you today to be chomping at the bit. Usually, I would say it's tough to rein you in.
Hold your rein. But I mean,
but today is exceptional.
But here's the little secret. I'll just say this bit. These markets mostly are up for the week.
Well,
it doesn't feel like it for a lot of people.
No,
it doesn't feel like it for a lot of people in a certain area of the market. But markets are up for the week by and large.
Well, that's some pretty good context for the markets that I'm going to walk you through now. Let me show you yesterday's moves. No? Just hold on. Give me 1 minute. We'll walk through the moves here, and then we'll get to what's been going on, what's driving the losses that we saw yesterday. We had a pretty bruising sell-off in tech stateside yesterday. The Nasdaq lost 2.3%. The S&P 500 and the Dow also lost heavily yesterday, both dropping more than 1.5%. Here's a look at some of the big movers to the downside in the tech space. Some of the key names: NVIDIA down more than 3.5%. You got Broadcom down more than 4%. Tesla, a major retail favorite, down more than 6.5%. CoreWeave down more than 8%. So very heavy selling in some of these tech favorites. In terms of treasury markets, here's a look for you at where bond markets moved over the course of the day, or where they stand right now, I should say. The U.S. 10-year currently around 4.121%, the 30-year trading higher, 4.7% right now, and the 5-year yield also moving higher, 3.7%. Meantime, the front end of the curve, we are seeing a little bit of a move lower, 3.5%, 3.58%. Is the level. Well, this is part of the reason I would argue that we saw a sell-off yesterday. Fed policymakers are weighing whether to ease interest rates further at the central bank's upcoming meeting in December, with market odds of a rate cut now at below 50%. So basically a coin toss. San Francisco Fed President Mary Daly said any decision about the next policy move was, quote, premature. Now, that echoed comments made by Minneapolis Fed President Neil Kashkari, who told Bloomberg earlier this week that he was on the fence as U.S. inflation continued to run high, but some sectors of the economy were performing well. Meanwhile, Boston Fed President Susan Collins said she saw a, quote, relatively high bar for additional easing in the coming months. Some of the most hawkish commentary coming out of her. Now, meantime, ADP private payrolls pointed to a slight recovery in hiring in October, with companies adding 42,000 jobs for the month. The White House said the October jobs and consumer price index reports are unlikely to be published as key statistical agencies stopped producing reports last month amid the shutdown. So all of that just to say that it is clearly still a murky picture when it comes to the data. But Steve, let's get into it. Markets, the reality is markets did sell off yesterday. You make a very fair point about how that's only one day basically, and markets are still, very resilient when you look over the longer term. But it seemed like a real perfect storm. You got some hawkish commentary coming out of the Fed. At the same time, you've got these concerns around debt in the AI space bubbling to the surface, and you had a little bit of a widening in bond spreads yesterday.
I'm kind of going to make for a bad couple of minutes because I agree with everything you've said. It's not the most dramatic, but I genuinely agree with you. I think the components coming from left, right, and centre, and there's one you haven't mentioned as well, which I will mention as well. I think it's extraordinary, and I think it is going to be a real test over the next couple of sessions for the buy the dip mantra. The heroes of this year in terms of hedge funds, institutions, blah, 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 it is the retail investor. The retail investor nailed it when everyone else failed ignominiously to buy the dip in April as well. But they've done it through buy the dip every single time. And it has worked so many times this year. I don't know this time's going to be different, but I think it's a real challenge. I think also with Bitcoin below 100,000, I think that's very, very psychological and important for a lot of the retail investors who have bought into the AI story and have done that accompanying Bitcoin as well. I agree with you entirely about the data. I think the data is extraordinary. So Mr. Trump blamed the Democrats, rightly or wrongly, I'm not getting involved in that, for the reason why we've had this shutdown for a long time. And of course the Democrats will blame the Republicans. So it's two ways as well. But everyone got excited. Oh, great, the end of the shutdown. And I've made the point a few times, is actually the market rallied during the shutdown because all the commentators came onto this channel to talk to you, me and Karen and others, and saying, doesn't matter. Okay, so we bought the shutdown, then we bought the prospect of the end of shutdown, and then they tried to buy the end of the shutdown. But then Collins and others have just made the very obvious point, well, if we've not got the data coming through, which the administration has said, then we can't assess accurately what's going on in CPI and unemployment. And if we can't accurately assess inflation and unemployment, then we can't cut rates. So it's almost self-defeating for the administration to turn around and say, you're not going to get your data because of the Democrats, maybe. Well, actually, if they had the data, the market thought it was a slam dunk for a December rate cut. I'll add one more point, and I think there's a lot you've said that I don't need to replicate, but about Trump himself and about the administration. And I want to tie it in with the politics at the moment, because there is no doubt about it, when you've got this problem within the Republican Party, which we haven't seen for a very long time, MAGA fighting MAGA Republicans, overtly at odds with the administration over the Epstein files and what have you, and the backlash to Mamdani and other victories for the Democrats as well, and the questioning about the luster of Donald Trump and how successful he's going to be going forward. Doubts on the political side, doubts on the economic side, doubts on positioning, doubts on the value of the debt, value on the value of the air. I think it's, as you quite rightly say, an incredible storm. I don't know what happens yet, and I'm not going to discount the retail buyer from coming in again.
Well, let me just pick you up on 2 points. One about the data, and the second about Bitcoin. But when it comes to the data and the fact that if we are to, maybe the solution is simply to, get this data, and it's understandable that the Fed doesn't want to necessarily commit before it's seen the data, but there's a possibility that Washington has an inkling that the inflation data might not be very helpful when it comes to the Fed. If we see that inflation is rising and potentially spreading to the services sector, that creates a very difficult backdrop. The administration
has been able to assimilate the data during the shutdown.
Well, there's a chance. I mean, they certainly are speaking to businesses, and we know that would hurt the case for a Fed cut. So just putting it out there that that's obviously a risk, that we do get the data and it shows that inflation is actually running hotter than the administration would like, and that complicates the case for the Fed, and that could change the trajectory of markets. And then finally on Bitcoin, just to wrap up, I think that is really key here, and I've heard various institutional investors flag this as a key warning sign that Bitcoin has come off over the last month, and that is really essential to the psyche of the retail investor.
I will just jump in on that, because I have been a skeptic of Bitcoin treasury maybe every time we've mentioned it on here. Not that there's a problem with companies holding Bitcoin, knock yourselves out if that's what you think, but the value of the Bitcoin treasury companies, the ones who have been doing the memes on MicroStrategy Michael Saylor, they were trading at a multiple of the underlying Bitcoin. And for me, that was symptomatic of the problem in the market, where you can have an underlying holding in Bitcoin in your company as part of Bitcoin strategy, treasury strategy, but you are trading at a multiple of the value of that Bitcoin because you have an aggressive Bitcoin strategy, rather than actually, if you were an investor, you could just buy the Bitcoin itself for the face value. For me, that just sounded very, very dangerous and very worrying. Now those Bitcoin treasury companies have plummeted. They have absolutely plummeted. Again, I'm not saying it's worth a buy or a sell. They've plummeted and valuations have come right back down. So I think that's another one of those symptoms of the bull market, which has just been evaporating over the last few weeks.
Yeah, and when those things happen, other things can sort of break following it. Let's welcome Russ Mould to the program, investment director at AJ Bell. Russ, great to have you with us. I don't know how much of Stephen and my conversation that you overheard, but very keen to just kick off with your take on what's been going on in markets this week and the selling that we've seen really accelerate over the last 24 hours.
Yeah, again, I think a lot of it is for better or for worse, centered on those AI and those technology stocks, and to a degree, Bitcoin, the risk on assets. They have led the market higher. They do have a disproportionate impact upon market cap and upon psychology. And at a time when, you got to a point when Nvidia's market capitalization was equivalent to the GDP of 84 million Germans rather than Nvidia's 36,000 employees, it's understandable that one or two questions are creeping in.
When it comes to the catalyst for the selling that we've seen this week, how much of it do you think comes down to the hawkish commentary that we've had out of the Fed and the fact that the market has become so comfortable and I would argue complacent about this notion that the Fed is going to cut in December?
Yeah, I think the complacency point is a good one. I mean, the last time we saw the Atlanta Fed GDP, now it's forecast for Q3 GDP, they were pretty strong. And so for the Fed to be cutting into what is on the face of it, healthy GDP, still low unemployment, decent wage growth, and you could argue frothy markets. It did feel as if the market was trying to have its cake and eat it by buying into the GDP and into the easing of policy. So maybe some recalibration of that is probably at the very least sensible.
Russ, lovely to see you this morning. You're in Brighton, are you?
I am, yes. I'm Sussex by the sea.
Yeah, I know. Well, I could have picked you up on the way through, my friend. You could have come in the office. But in all seriousness, the problem is, if we do have a rout that continues in AI stocks and tech stocks, and some of those valuations come off somewhat, it will affect everything. And this is the problem. Whilst the rest of the market isn't trading at those those exacerbated multiples, the fact of the matter is it's hard to find pockets where the rest of the market is actually cheap. Agree there is a valuation disparity, but the rest of the market isn't necessarily cheap. Even those great stocks that AJ Bell and others will perhaps say look better value, they will come off in this route as well, just because of the component of how people put together their portfolios, and of course how those funds have such a weighting in those big stocks, but they also have weightings in the rest. And if we're going to sell the funds down, everything's going to get sold off, isn't it?
There's a risk. I mean, I think when I started off as a very junior fund manager in 1991, one of the first things I was taught was that during times of a crisis, all correlations go to one. And I started during a bear market in European equities, which was my speciality in 1991. That's probably coloured my views forever. But that is always the danger. If you do start to see liquidations in one area, then investors may look to lock in profits that they've got in others, Bitcoin, gold, wherever it happens to be. And then, the more speculative, more expensive areas perhaps go down faster, but it may be difficult to find protection. The best ways to protect yourself, diversification is one, free lunch, and trying to, again, as you say, find those nuggets of value, or at least go for areas where the valuations aren't as extended, will certainly help protect you on the downside, even perhaps mean you're not immune from it, as you say, in a worst case scenario.
Yeah, the problem is, for me, I have many problems, as you know, but my Instagram feed at the moment is full of wise words from Charlie Munger and Warren Buffett. That's not actually a problem. It's actually quite nice. But I keep getting all these old quotes from the two doyens of business and investing. And one of the ones that keeps coming up on my feed from Mr. Buffett is you've got to be prepared to lose 50% of your investment 50%. And still want to hold it. I'm just worried about entry points for our viewers.
Yeah, and I think one of my favourite Buffett quotes is, given this debate that's been ongoing about Berkshire Hathaway's ever-growing cash pile to $382 billion, the old Buffett quote about how cash and courage are priceless during a crisis. Yes, building up a cash buffer, again, is one way that you can protect yourself. It is uncomfortable, and it's uncomfortable to do it when markets are rising. And it's actually even more uncomfortable to apply that money when markets are falling, because it requires an awful lot of courage and an awful lot of patience. And I think there is that danger that after the very, very easy run we've had, the buy on the dip mentality has worked. If that faith in that mentality is challenged, it could get bumpy, absolutely.
Russ, there is a constructive view circulating this morning that the selling that we've seen in tech has actually been a good thing this week, because investors seem to be distinguishing between the AI major players, the hyperscalers, that we have seen sentiment turn sour for the likes of Meta, for the likes of Oracle, but for a company like Alphabet, for example, where the revenue stream from these AI investments is more obvious and where the cash pile is very healthy, you're seeing continued appetite for a name like that. And I think on our screens right there, you can see over the last year, but if you zoom in just on the last month, you can see that Alphabet has outperformed the likes of Meta, the likes of Oracle. Is it possible that we're simply heading into a healthier phase here where investors aren't necessarily souring or getting really downbeat about AI, but just becoming more discerning around where to put where they want to put their money?
I think that's right. I think a more rational parsing of, it's going to be really hard for all of these companies to win. And if you look at the history of technology stocks over time, eventually one generation's disruptors become the disrupted. And I think one of the biggest, most intriguing facets about the current enthusiasm for AI is, yes, you have a lot of asset-light businesses like the names that you've just mentioned are now becoming a lot asset-heavier because of the data centers, because of the servers, the racks, and the chipsets that they're falling over themselves to buy. And also, for the first time, they're starting to move out of their own walled gardens and encroach upon each other's territory. So I think to blithely assume that they are all going to win is probably pretty dangerous. I think I can understand why people will be gravitating towards Alphabet as a more likely winner. As you said, you can see some of the benefits already. I think it has 7, 8, or 9 businesses streams that have got 1 billion users at least. So it's going to be a very, very difficult business to dislodge in some ways, and maybe in some ways much harder than others. And it has that balance sheet strength, which again, if you're looking for a haven during times of trouble to get you from the one side of the volatility to the other, a strong balance sheet and decent cash flows are pretty good places to start.
Mr. Mould, thank you very much indeed. I thought you were going to sing earlier on the song Sussex by the Sea, which is a particularly awful anthem.
Definitely. But, you don't want to hear me sing.
Please don't, really. Unless you're a Brighton fan, we mustn't do that. Lovely to see you, Russell. And thank you very much for your time. Russ Mould, who is Investment Director at AJ Bell. I encourage you lot to email me. You know I take the good and the bad, so just carry on. And I've had a very nice email from Patrick this morning. By the way, that's my email address. Something like that. If you want to get involved, do, by all means. I will read all your emails, but nice one. So we've referenced your comments this morning. He's referencing Robert Armstrong in today's FT. He points out that the falls in the big tech sector are a result of investors no longer seeing them as capital-light cash generators. I have the page open on the FT, Patrick. I will have a look. Thank you. You guys help educate me, and hopefully we can have some good conversations which we'll all learn something about.
Let me just add to that and say that my last question to Russ was actually spurred by Robert Armstrong this morning, because he made the point that investors are not indiscriminately selling these AI names. They're being much more selective. And when you look at the performance of the likes of Alphabet versus Oracle, it just shows that investors are being more discerning here.
Yeah, they're looking at the cash flow, they're looking at the debt profile, and looking at the cost on that debt as well. It's great. Thank you. Thank you, viewers. Thank you, Juliana.
Coming up on the show, a bout of risk aversion sends stocks sharply lower overnight as bets on the Fed cutting rates in December fall below 50%. Plus, UK Chancellor Rachel Reeves has reportedly ditched her manifesto-breaking plan to raise income tax. That's a huge story. But how will she plug the estimated £30 billion fiscal hole? We'll ask what's going on in Westminster. And Swiss Re reports surging profits in the first 9 months of the year. We speak to the group's CFO, Anders Malmström, at 9:15 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. What you lot out there don't know is that I've got a little camera in each of your rooms or on your computers where I can see what you're doing. So I want to just ask a question. Can you all put your hand up if you have a clue what is going to happen in the UK budget? I'm looking at you. You're in Wisconsin. You're in New Delhi. You're in Wokingham. Okay, I can see you. Not one of you got your hand up. No one's got it. And I bet you no one's got a clue at number 11 Downing Street either. It's just extraordinary. I'll tell you why I'm saying this, because the spotlight appears to have shifted from fiscal headroom to political capital, whatever that means, here in the UK. As outlets report this morning, wait for it, that Prime Minister Sir Keir Starmer and Chancellor of the Exchequer Rachel Reeves have ditched manifesto-breaking plans to hike income tax. So they ditched the manifesto, they've ditched the plans to. So it's kind of like back where you started, really. Potentially one of the most significant double U-turns in recent memory. So Ritika comes into the office this morning and she just looks at me and I'm like, I don't know. We're both incredibly confused, Ritika, but you're going to make us less confused.
You know what? I don't know if I am, Steve. I'm still confused. You're confused. The viewers at home are confused. But the Financial Times is saying that the decision to rip up the tax plans was communicated to the Office for Budget Responsibility on Wednesday, barely 2 weeks before Budget Day, and only a week after Reeves reportedly floated this idea of income tax hikes with them in the first place. CNBC has reached out to the Treasury for comment. Now questions remain on how the Chancellor will fill a fiscal hole that Deutsche Bank analysts reckon could top £30 billion. One option is to reduce the threshold at which employees start paying the higher rate of income tax while leaving the rates unchanged, potentially raising billions of pounds. One taxpayer in 5 is already set to cross the threshold by the end of next year, according to the IFS. Reeves was reportedly seen leaving Downing Street with the word thresholds visible in her diary. Whichever way the Chancellor decides to fill her fiscal headroom, these latest reports mark a dramatic end to what has been a very turbulent week on Downing Street, certainly. Now, the countdown to the budget has dominated conversation here on CNBC in recent weeks. Take a listen.
We can be reasonably confident now, largely because the Chancellor has said it, which is going to be a productivity downgrade from the independent fiscal watchdog, the Office for Budget Responsibility. The hit is likely to be somewhere around £20 billion.
The concern is unemployment has continued to go up, now at 5%, which is a high post-pandemic, and that's a direction of travel that we were expecting. But there is a sort of chink that I saw in the data that encouraged me in that the number of vacancies has stopped falling. You might remember I was concerned that we'd had 39 consecutive periods of declining job vacancies. They actually rose by 0.2% in this period.
If we think about all the foundational things that you need for to be optimistic, a government talking about growth, a strong regulatory backdrop, you've got some real changes in regulation, certainly for us on things like targeted support, which will help our business, Solvency UK, which will help our business, all of these, and then, investment in infrastructure, which we obviously invest in. All of these should be things which should come together and produce a good outcome. That vision of what all of that together means for the economy, means for you, us as consumers, us as businesses, that's not there at the moment.
I'm going to take credit for producer Jordan's comment. He said maybe I should call it an O-turn. It's now mine. It's an O-turn because she's gone from a U to a U. So we've completed the circle.
Degrees,
So I have two problems with this. One, the fact that we've all been wait so long, which has created so much uncertainty. The history of budgets is you do not wait till the last week of November as well and flag it up. And so that in itself creates uncertainty. But two, this is where Labour gets themselves into so much trouble with the Wes Streeting affair as well, is that the briefings and then the counter briefings and telling people what they're going to do, and even, tell me, I'm lost track. Was it only last week she had made the speech which laid down the foundations for income tax rises? So we all get used to the idea, and yet a week later, another U-turn.
I mean,
it's really bad for investment.
Yeah, bad for investment. Also just a bad look in general. Like we're talking about the words messy, chaotic, weak kind of do spring to mind here. I mean, this screams kind of panic in Downing Street in a way, because Keir Starmer and Rachel Reeves now scrapping those plans to break the manifesto. This is just 2 weeks ahead of the budget, and we just talked there about just last week it was, where she gave this unscheduled scheduled speech where she kind of paved the way for tax hikes. And then now with all of this chaos in Downing Street over this leadership battle with Keir Starmer, now Downing Street backing down on those plans to break the manifesto. So clearly she's worried about her own MPs, about they're not able to have control over their own party, more than the markets, more than her concern and more of her fears of bond vigilantes. So that's been a real really interesting shift, because that's really what they've been playing up to. They've been saying that Keir Starmer and Rachel Reeves, these are the people that are going to keep bond markets in check and going to be good for the markets. But now they seem to be more scared of their own party.
Well, when it comes to bond markets and what investors want to see from this government, now the reporting suggests that Rachel Reeves is looking at these thresholds and just adjusting the thresholds as a means through which of getting more revenues in. How are analysts thinking about the potential revenue uplift that we could get if we do see her simply adjust the thresholds but not actually go for income tax hikes?
Yeah, and I think it's expected that the freezing the income tax thresholds that we talked about before could raise about £8 billion, and then on top of that now reducing the thresholds at which employees start paying the higher rate of tax could raise extra billions in that. But there's been a lot of criticism about tinkering, about doing these kind of smorgasbord of measures that were not clean, that are not likely to raise as much tax as just raise as much revenue, as just simply raising income taxes. So that was the criticism. And again, if she's also not able to cut spending, that's when it gets tricky as well.
When it comes to not being able to cut spending, I mean, when you look back at July and the push on this welfare vote and ultimately the massive U-turn that the government was forced to take, Steve made this point yesterday. I mean, you can't really think of a better scenario if you were a government in power than to have the large majority that Labour has, and yet they can't seem to pull anything significant off.
Yeah, I mean, that just speaks to them not being on the same page as a party. What does this party represent? They're not able to agree on anything, and now we're seeing them cave in to the far left of their own party. It's just a bad look.